August 11th, 2020. A team in the loan operations group at Citibank, America's third largest bank, initiated a wire transfer, a $7.8 million interest payment to the creditors of the cosmetics giant, Revlon. It was a routine operation. 3 people reviewed the transaction. They followed a 6 eyes protocol. They entered the wire details into their back office software. They clicked send. But instead of $7.8 million, Citibank accidentally wired $894 million. Nearly $1 billion of the bank's own capital was sent out of the bank. This wasn't just a simple mistake. It was a failure of design that would spark a multi-year legal battle and have a lasting impact on the industry. The story begins in 2016 when a group of investors lent Revlon a total of $1.8 billion. Citibank was the loan's administrator, responsible for moving payments between the parties. To understand where this went wrong, we have to look at the software, Oracle Flexcube. It looks like standard 1990s software, because essentially, it was. For wires like this, they used a 6 eyes protocol. 3 people had to verify it: a maker, a checker, and an approver. For this transaction, the maker and checker were subcontractors at Wipro, based in India. The approver was a senior manager at Citibank in Delaware. There was a slight problem. Flexcube wasn't designed to handle this specific type of transaction, so Citibank had implemented a workaround. They would initiate a payment for the entire amount of the loan, but redirect the principal to an internal wash account. To do this, they had to check 3 boxes: front, fund, and principal. But the maker of the wire selected only principal. He believed, logically, that this would redirect the principal to the wash account. The checker reviewed the details and made the same assumption. It was then sent to the approver, who replied by email, "Looks good, please proceed. Principal is going to wash." But they were wrong. If front and fund were not checked, Flexcube would revert to its default instructions and wire the full amount. As the final button was clicked, a warning popped up on the screen. Meant to be the last line of defense, it read, "Account used is wire account and funds will be sent out of the bank. Do you want to continue?" But it didn't mention the amounts or the recipients. Because the team was intending to send a payment, they assumed it was a routine warning and clicked yes. And with that, nearly $900 million of the bank's own capital left its accounts. On the morning of August 12th, the checker was doing his morning reconciliation. He quickly discovered a series of huge discrepancies. The $894 million intended for the internal wash account had instead been wired out to 315 different lenders. The first alarm was raised in an email to a senior manager, reporting that even though principal was checked and the account number set to wash, the funds had gone out anyway. Staff initially suspected a technical error. The news was escalated to Citibank leadership. In a Skype chat, one manager wrote, "Bad news, principal to wash, wires look like they went out the door." An urgent email was sent to the technology support group with the subject line, "Urgent, wash account does not work." It was believed that Flexcube was not working properly and was sending full payments. However, by early afternoon, the investigation had shifted from software bugs to human error. Citibank officially alerted the front office. Recall notices were blasted to hundreds of investment firms, explaining the transfer was a mistake and asking for the funds to be returned. Some investment firm employees couldn't believe it and joked over the error. Many investors saw the mistake and sent the money back. Around $385 million was returned. But 10 of the investment firms, including Brigade Capital and HPS Investment Partners, thought differently. Revlon was in financial trouble. The debt was already trading as low as 20% of its face value. And these investors were already in a legal dispute with Revlon over an earlier restructure. And now they had the full amount of the loan sitting in their accounts. The timing couldn't have been better. Lawyers representing the investors identified a niche New York rule called discharge for value, which states that if a lender receives funds it is owed, and has no reason to believe it was a mistake, they are entitled to keep them. They refused to return the money and rebuffed Citibank's recall notice, stating, "It is not at all clear that the funds were sent as a result of a clerical mistake. It is not believable that a sophisticated institution like Citibank could have transferred nearly $1 billion in the exact amount outstanding in error." In February 2021, a US District Court judge agreed. He ruled that because the amount the lenders were sent matched the debt to the penny, they had no reason to believe it was a mistake. Citibank, one of the largest banks in the world, had just lost a $500 million court battle because of a checkbox. The story didn't end there. In 2022, an appeals court finally reversed the decision, ordering the firms to return the funds. It ruled that because the loan wasn't due for another 3 years and Revlon's business was struggling, they should have known it was a mistake. Citibank finally got their money back, but the damage was done. Revlon, already struggling, was caught in legal crossfire and eventually filed for bankruptcy. Citibank didn't escape unscathed either. Federal regulators fined them $400 million for long-standing internal deficiencies, with the Revlon blunder widely thought to be the final straw. The incident's legacy lives on to this day. Many commercial loan agreements now include a clause known as the Revlon blocker. It serves as a cautionary tale of using antiquated enterprise software and has become a legendary case study in UX design.